Hi, everybody. Hope everybody is doing fine. If you haven't checked already, I did finish grading the exams. Class as a whole did pretty well. The average was about 85%, so good work. I think it's a little different. Maybe I'm not an expert yet in trying to write online principles exams, something I've never had to do before. But whatever it was, I set it up, and you guys on average did really well. So I want to turn our attention now to the idea of monetary policy, and it's conducted by the Federal Reserve. This will be the first of several lectures on the topic. So what we saw before was sometimes there will be some kind of shock. Something will happen, and it will cause aggregate demand to fall. During the Great Depression, when the stock market crashed and actually the government cut back spending, aggregate demand fell and unemployment rose. During the Great Recession, housing prices declined, people felt poorer, and aggregate demand fell. Now what we're seeing today with the COVID virus going around, people have lost their jobs, they don't have much money to spend, and the result is aggregate demand has fallen. So sometimes we call this a shock. Something has caused a fall in aggregate demand. Now, what we need to do somehow is get aggregate demand back to where it was originally. The classical economist said you don't need to do anything. Wages will fall, and as a result, the aggregate supply curve will shift out, and the result is we'll be back to where we were before. The problem, as Keynes pointed out, is this wages only fall slowly. He said they're sticky in a downward direction. So Keynesian economics is one that advocates a more active role for the government. There are really two different types of policies: monetary policy, which we're going to start discussing now, and fiscal policy, which we're going to be discussing next week. My friend and colleague, Professor Alice Simon, teaches a really great course called Monetary and Fiscal Policy. So if you're looking for a good future course to take, by the way, it's a writing option course. It's a really good course. She's a really great professor. Something to keep in mind for the future. So anyway, let's begin today talking about monetary policy. So when we use the term, what do we mean? Every nation has what's called a central bank. This is not quite a government bank, but it's certainly not a private bank. And this bank, which is usually, not always, but in the United States, independent from the government, what happens is they will influence interest rates, monetary policy. The nation's central bank tries to influence interest rates. If interest rates go down, this will cause consumption and investment to rise. It will raise aggregate demand and therefore real GDP. If they're worried about inflation, this is something that happened in the United States in the late 70s, early 80s. The Fed raised interest rates through the roof. Consumption fell, investment fell, aggregate demand fell. It put downward pressure on prices, but it caused a pretty deep recession. Now, in the United States, the central bank is called the Federal Reserve System. We'll call it the Fed for short. I know we have a class member who's from the Turkish Republic of Northern Cyprus, and they call it the Central Bank of Turkish Republic of Northern Cyprus. I will not even attempt to pronounce that. In Pakistan, we have a student from Pakistan. It's called the State Bank of Pakistan. England, it's the Bank of England. Japan, the Bank of Japan. For those of you that are interested in international studies, European relations, Europe has a monetary union. It does not include all of the nations of the European Union. And those nations have a European central bank, those nations that are in what is called the European Monetary Union. So various names, but in the US, we call it the Fed. Now the Fed has three parts. You're going to notice in this part of the course, the macro part of the course, things tend to come in three. So there's three parts of the Federal Reserve System. One part is called the Board of Governors. These are 7 people. They're not governors of states, but they're 7 people that are nominated by the president and have to be confirmed, or not, by Congress. Right now, as we speak, there are only 5 people. President Trump has nominated 2 people, but the Senate has not confirmed them. I'm not going to make any bets, but my best guess, at least one, if not both of them, will not get confirmed by the Senate. So at the moment, we don't have a full Federal Reserve. The idea is these people should be totally independent of the government. They shouldn't be trying to influence interest rates right before an election, dropping them to help get the president reelected. So the idea is if they have a 14-year term, they can do whatever they want. Now, do whatever they want to look out for the good of the country in the long run. One of the people on the Federal Reserve is appointed the chair of the Federal Reserve. Right now it's Jay Powell. Before that it was Janet Yellen. Before that it was Ben Bernanke. President Trump nominated Jay Powell to be head of the Federal Reserve. It's a 4-year term. The Fed has not dropped interest rates as quickly, at least prior to the recent crisis. The Fed was not dropping interest rates as quickly as President Trump wanted, and there was nothing he can do. The Federal Reserve is independent. Their job is to look out for the long run of the country, not bow to political pressure. So that's one part of the Federal Reserve system. The Federal Reserve also has 12 regional Federal Reserve banks. These help carry out the policies of the Federal Reserve. The most important of these 12 banks is the one in New York. The head of the New York Federal Reserve, the president of the New York Federal Reserve, he's really the most important of the 12 regional bank presidents. I won't list where all of the 12 are, but those of you from the Cleveland area, there is a Federal Reserve Bank up in Cleveland. And finally, there's something called the Federal Open Market Committee. The 7 members of the board, now only 5, and 5 of the 12 regional Federal Reserve Bank presidents serve on a rotating basis. We always have the members of the Board of Governors, and a rotation system is worked out so they take turns as to which of the members of the presidents of the regional banks serve on this Federal Open Market Committee. And what we're going to begin doing now is talking about how these parts of the Federal Reserve System influence monetary policy, to influence interest rates, to influence consumption and investment, to influence aggregate demand. So, wait, things in this part of the course tend to come in 3s. That's right. In general, when I first started teaching this, actually, up until about 12 years ago, I always said there are only 3 tools that the Fed has. The reserve requirement, we'll talk about that today, the discount rate, and open market operations. That'll be our next lecture. And only recently, there's only been twice in the United States, the Great Recession and today, they've used something called quantitative easing. And we'll talk about that. Now, the Board of Governors, supposed to be 7, but at the moment 5 people, these people set what's called the reserve requirement. They vote and say, okay, we are going to tell banks they must keep a certain percentage of their deposits in reserve. What that means is they don't loan them out. They must be available. So banks, remember that 363 rule, banks get deposits, but they can't loan everything out. And keeping the money in reserve, there are only 2 ways that the Fed allows that. 1, they can physically keep it at the bank. So if somebody walks in and says, I want to take money out of my checking account, the bank has it. And the other thing, if they don't want to keep all the money there, they can deposit it at the Fed. And the Fed does not pay interest to the bank, but those are the only 2 ways they can keep the money in reserve. So let's look at an example. And let's say the Board of Governors says, we're going to set the reserve requirement at 20%. And banks want to loan out all they can. Let's say this is a time when banks say, hey, we think the economy is going strong, but they're not allowed to loan out every last dollar. If they have $20,000 in deposits and the Board of Governors sets the reserve requirement at 20%, they're independent people, they set it where they like. So if they have $20,000 in deposit and the Fed says you have to keep $20,000 in reserve, that means of their $20,000 deposited, $4,000 is kept in reserve, and the rest they can loan out. Hopefully at a high enough interest rate for them that they can make some money. But now, suppose the Fed looks out and sees aggregate demand has gone down. They want to increase aggregate demand back. I'm sorry, that should say A0, A0. I goofed there. I can never make a lecture with slides that are always perfect. Okay, anyway, suppose they want to get aggregate demand back to where it was and reduce unemployment as they're raising GDP. One of the things they can do if they want to stimulate the economy, raise aggregate demand, is lower the reserve requirement. They can tell banks, hey, instead of having to keep 20% in reserve, we're going to let you only keep 15% in reserve. In other words, instead of having to keep $4,000 in reserve, you only have to keep $3,000 in reserve. You can loan out more money. Now, banks can make more loans because they have permission to loan out a greater share of their deposits. Now, to get more people to borrow the money, the bank has to figure out, okay, look, if the bank only had previously $16,000 to loan out, maybe they charge 4% interest. If they have more money to loan out, how do they get people to borrow more money? The answer is they drop the interest rate. If we drop the price of something, people are going to want more of it. And the price of money is the interest rate. So if the bank reduces the interest rate, people will borrow that money. It raises consumption. It raises investment, which raises GDP, and hallelujah, unemployment is down. Now, this can work in theory, usually. But there's something very important to keep in mind. The bank does not have to make the loans. If the bank looks out there and says, hey, we don't think there are any good customers out there. The only people that are out there, they don't have good credit rating. We don't want to make the loans to them. They don't have to. You can't force a bank to make the loans. You can only give them permission to make the loans. And if they don't want to make them, they don't have to. So this is a limit of lowering the reserve requirement. You can only give the bank permission to make a loan. It's like me saying, look, I give you permission to jump out of off the roof of your house. You have my permission, but I really hope you don't do that. Now, this is very disruptive if we allow banks to, if we change the reserve requirement. If we make it too low, maybe banks won't have enough money. If we raise it too abruptly, it could cause problems because the banks don't have enough in reserve. They'd have to call in loans. This is very rarely used in the United States. In your lifetime, we haven't really changed the reserve requirement. China has lowered the reserve requirement several times to stimulate the economy. In the United States right now, it's so low that they really haven't talked at all, even during the recent crisis, about lowering the reserve requirement. So that's the first tool that the Federal Reserve has. In our next lecture, we'll talk about the other tools. Take care, stay well.